Jay McCanless, Wedbush housing analyst, joins us now. All of those variables you talk about, supply issues will remain, yet it will be a purchase-centric market. How does that calculus work out?
So, good morning. Thank you for having me on. I think for the home builders, they're benefiting from a pretty severe lack of existing homes for sale, which historically have been the home builders' biggest competitors. I think they're going to benefit from that. I think also with rates trying to stabilize high sixes, low sevens, that's going to help people be more confident in what their monthly payment's going to look like. And then on top of it, the builders have the ability now to build homes faster. Cycle times have come in. So for people who want to buy and have qualified to buy the home, the builders can deliver that home faster. So we think from a mortgage perspective, purchase mortgages are going to be certainly up, we think, over last year. And with assuming as we do that mortgage rates probably stay around these levels, there's just not going to be as many opportunities for refinance as there is potentially for writing purchase mortgages.
Do yields rising over the last 5 weeks change, the interest level, the demand for these mortgages and for that purchase-centric market you described?
I think it's certainly gonna slow things down a little bit. As you move rates higher, your addressable market is going to shrink a little bit. But in terms of the underlying demand for the houses, what we've seen is that when mortgage rates pull back, the demand shows up. I think from the home builder perspective, they are probably going to have to be doing a little more on the buy down side in terms of buying down mortgage rates to keep these homes affordable. But no, I think the demographics in terms of the size of the millennial population and now the Gen Z population coming into home ownership, I think we've got very strong tailwinds behind us. It's just figuring out from the builder's perspective and from the mortgage perspective what that affordable monthly payment is.
And I know you've been focused on the non-banks as well. We spoke a little bit yesterday about the Basel III endgame capital rules and how that's, if they're finalized in the way that they're written, could cause banks to retreat in certain areas, including mortgages. How do you think that might change the game for the non-bank financial sector, and what does that mean for the overall housing market?
So I think you probably see, we're home builder analysts, we don't really cover the banking sector, but I think the read through is that the non-banks probably do gain some share in here. I think that's an easy assumption to make, just given all the different things that the banks are having to face on the regulatory front. I think for the home builders specifically, some of the builders have their own internal mortgage operations. That's going to give them the ability to maybe be a little more aggressive in terms of buying down rates and being more competitive relative to where maybe your local bank is or some of the larger banks are. So for the builders that have their own mortgage companies, I think this has been something of a tailwind, giving them the ability to be more competitive and help buyers find that right payment for them.